the S&P 500 reaches 5,000 for the first time in history. The question is, now what? We're going to get some clues from inter-market analysis. That's what I'd like to focus on today in the Study Wealth Podcast. Hey, everybody, welcome to another episode of Study Wealth Podcast. I'm your host, Serge Berger, and I would like to have a look and take a step back at this market with equities continue to push higher, certainly very much benefiting and paying trend followers. And what I'd like to do today is have a look at inter-market analysis. First, let's define a little bit what that actually is and see if we might be getting some clues from markets such as the dollar market, copper, interest rates as to what may be the upside potential here still in the very near term for the next few weeks, month or two for the US equity market, very much focusing here on the S&P 500, because again, it is driven by a few names. Before we look at that, though, let me mention something that came up with several discussions with clients last week that I mentioned, which is something that I think not that many people have talked about yet. And that is the concentration of equity markets, not just in the S&P 500 or NASDAQ. We all know we have the Max 7s that are largely concentrating and ruling the day. However, we have a very similar concentration in Europe. If you look at the German DAX, for example, or the Europe Stocks 50, and you will find a really outsized concentration in a few stocks like SAP, which is a very large technology stock, a company, a software firm, like Siemens, another technology company, in LVMH, which is a luxury brand, and a couple others, of course, as well in there. And so the concentration in a few of these stocks that don't have much debt, that have growth, that may have an AI factor, not all of them, but a good amount of them, is really a both on both sides of the Atlantic, something that is playing out. Let's have a look at intra-market analysis. So we know the S&P 500 has reached its $5,000 level. To me, I think we highlighted this over the past couple of weeks. Certainly, it has been an extensive talking point to clients, both on the Blue Marlin Advisors side, our investment advisory firm, and on the research side at the Study Trader, that we did think that 5,000 was in the cards. Just algorithms want to get to that number, and it makes a lot of sense. Now, to get some signals from where we may be heading next, let's understand intra-market analysis. First of all, what is the definition of inter-market analysis? Inter-market analysis is just the understanding the relationships between different asset classes, markets, and sectors to make, I would argue, better informed decisions that go outside of, let's say, traditional technical analysis and go above and beyond fundamental analysis and really allow us to look at what I consider to be structural analysis. That's my definition of it. I think interconnectedness of markets is something that has become, over the past 10 years, something that less and less people, certainly on the retail side, but even on the institutional side, have worried about, because we've seen such a massive move in the equity market, and it's more or less disconnected with a lot of other markets if you look at it longer term, but it does really give us critical signals when things get stretched in one direction or another. So, for example, last October, in late October, in the middle to late October into early November, we had clear major divergences and signals from an inter-market connectedness that told us that we're going to probably get a pretty good equity rally. We're now getting the opposite signal. So let's have a look at that. And the reason this is important, if you think about the globe as a whole, right? It's not just investors in Kansas and in California or in Florida that are investing in this case, the S&P 500. It's a global market, very much like the German DAX is not just being invested by local Germans, or in Asia, it's not just local Asian investors. It's really global, right? Investors are global, particularly the big ones, the ones that have all the money, the institutional investor. They have global mandates, even if it's an ETF. If you think about an ETF that you might buy, a US listed ETF that might focus on Asia, clearly there's influences there in those markets from a US investor perspective. On top of that, you have to take into consideration interest rates and, of course, currencies. The two of them are closely interlinked. And if we think about what interest rate policy in one country means to a stock market somewhere else, particularly the dollar denominated currency, US dollar, which of course is related to the Fed and interest rates there, what that can mean from other things. So we can really get clear signals. Speaking of the bond market and the dollar, it's not just interest rates, but it's also because of interest rates what investors do. So an investor, a foreign investor, might say, okay, I'm going to buy more dollars because interest rates are going up. That ultimately has an influence on the equity market and can lead the equity market. What I'm trying to tell you, as much as if you look at the past 12 years, it looks like the US equity market is its own thing and doesn't care about anything else. If you look at it through a multi-month, multi-quarter lens, it's very much not the case. You can get massive dislocations that quickly get the snapback. And so the sort of the moral of the story, or the reason why we wouldn't want to use inter-analysis or intra-market analysis, is because when you have a big move in equities, let's say, again, either on the way down, like last October's lows, or now into 5,000 S&P, what tends to happen is something that I talk about and warn all the time, is that the mean reversion happens so fast that investors, particularly retail investors that are doing chart breakout kind of stuff or trend following, erase months of gains in a matter of days or a couple of weeks. And so a lot of the work then has been erased, and we don't want that. We want to be aware of the consequences of these interconnections. So I think, risk management is really where the interconnectedness is important. We're going to look at some charts here. I will talk to some charts here and look at some of these interconnectedness or disconnections at this point that we're seeing playing out in the market. We can use these signals not only from a trading perspective, but also from a portfolio management perspective. So if you are a self-directed investor listening to this right now, or you are an investment advisor or a professional investor at an institutional shop, these are risk management exercises that we can do. I think understanding that the equity market is not just moving on its own, but it is very much linked to global markets and outside global market equity market forces, again, interest rates and currencies and some commodities, and we'll talk about that here today with copper, because there's a big divergence taking place. Is really eye-opening. I think the long-term benefits for investors of using intermarket analysis is just enhanced portfolio resiliency. Again, that goes back to the point that I just mentioned, where we don't want to give up months worth of gains in 1 or 2 days or weeks, which again, for most people will happen and happens all the time. So people that were short last October basically got carried out in a matter of a couple of weeks while they made money over 2 or 3 months. Again, those are the things we want to avoid. So we can enhance portfolio resiliency, reduce volatility, and improve overall performance by being aware of what's going on in intramarket analysis. So I think intramarket analysis, adapting it to analysis, I think is a really crucial part that I would suggest everyone to consider. So having said that, I brought along a chart and I will talk to this. So as I always say, if you're listening to this on YouTube or watching YouTube, you're going to see the chart. If you are listening to a traditional podcast channel here, Apple, iTunes, or whatever podcast, you will be hearing me talk to the charts again. You won't miss a beat. Do not worry. So let me share my chart or my screen here, and let's talk to what's going on here. What I'm going to do here is I'm going to show you some of what I consider to be the most important market correlations as it relates to equities. Right, we're taking this back to the equity market because the equity market right now is seeing such a big move. Again, S&P 500 having reached that 5,000 mark. So let's start off with a relationship, and I want to quickly foreshadow, we are going to talk about copper here and the big divergence there in just a couple of minutes. But let's first talk about the correlation between the equity market. So again, equity here, we're referring to the S&P 500, and in this case, the dollar index. So basically the US dollar, which is as a basket versus other currencies. And if we look at it, and then we're looking at it over the past few years, and we do have to take the past few years as a thing, there are plenty of periods of time where the dollar and equities can move up together. So for example, the dollar moved higher in 2021 along with equities all the way up until, let's call it from June to December 2021. That's 5 or 6 months. There were major hiccups along the way, and that's what I'm trying to get to, right? You might get these longer-term correlations right. The problem is if you're wrong on a multi-week or 1 to 3 month basis, it completely defeats the purpose. But in general, what we've seen over the past number of years is essentially an inverse correlation, particularly when one stretches too far in one direction or another. So particularly in this case right now, where if we're looking at this here, we have two lines on the screen, the equity market, again, the S&P having had a big rally. The dollar has also lifted, ironically, since late, or just actually what we would expect since late December. But we've had this inverse correlation. Basically, this goes to something I talked about last week and been talking to clients about for weeks and weeks now. The top in the equity market last year in the summer came basically a few weeks after the dollar market bottomed. Again, there's an inverse correlation. So if the dollar starts to rally, it is typically a matter of time, particularly if equities rally very strongly, which is exactly what happened last June into July. It is a matter of time until the equity market corrects. Last year in June, when we saw exactly that play out into July, the equity market ended up correcting whatever it was, like 10, 20% or something like that within a couple of months. Then we had the inverse happened of that. And what I'm showing here or describing you on the chart here right now is essentially when the equity market bottomed. So the dollar started to top. So after having bottomed in July ahead of the equity market and followed lower, the dollar had a strong rally, started to top in early October. And a few weeks later, by the end of the month, we saw the equity market start to bottom. Again, there's an inverse correlation. Fast forward to now, we've seen a few weeks ago, in this case, it's about 6 or 7 weeks ago or something like that. Again, that's very much in line with historical sort of time lags. We saw the dollar bottom. In fact, the dollar bottomed somewhere very late December. The equity market didn't care for much more than a few days and took off very strongly to the upside. The dollar has continued to rally since then, and the equity market has accelerated its rally. So to us, it's extremely likely that we're going to start to see some consolidation period here. It could be vicious to start. We could see a 2-3% drop in one day, and then that continue over the course of a few weeks or a couple of months until the point the equity market corrects 10, 15, 20% if the dollar remains strong. And that, of course, is the big thing, that this is the whole point of intermarket analysis. So that's the dollar. Another way we can look at this is we can look at dollar yen. Now, this is more or less the same point, but I'm going to just bring this out so everyone can see this. Dollar yen, which again is essentially the dollar index in many ways, and also has that inverse correlation. It's not as easy to see here because it's pegged to an individual country's currency and not just the dollar index more broadly diversified. But here too, you can see the dollar yen actually topped. In fact, this was a bit lagging, right? But it's confirming. So dollar yen, because it's one currency pair, not the dollar index is a better signal, what I'm trying to tell you. But here too, we have an inverse correlation. But what we've seen as of late is the dollar yen again bottoming like the dollar index in late December and rip roaring higher, actually more than the dollar index. It's actually been a really big solid bid for the dollar index. The equity market has not cared yet. But again, I do think it ultimately will. So that's the dollar yen. If you want to look at dollar yen, I think the dollar index is a cleaner, more diversified way of looking at it, in my humble opinion. That gets us to yields. So one thing we can do is, we very much like the dollar, 10-year yields have been having an inverse correlation to the equity market, meaning a positive correlation in price terms. What I'm showing here is the same thing I just showed a second ago. Just now we're looking at the S&P versus 10-year yields. 10-year yields actually top. Again, they are a leading indicator in my experience to the equity market. So 10-year yields topped a little bit after the dollar last autumn, somewhere in the middle of October, and about 2-3 weeks later, the equity market bottomed. So again, the inverse correlation. So when yields topped, ultimately it was a matter of time for the equity market to bottom. Now we actually saw in late December yields bottom. Yields continue to make a series of higher lows. If not, it made a higher high, which is why we've been talking about a level to our clients around 4.2% in the 10-year. If we were to break above there, again, it's an if, it would be even further confirmation for the equity market to likely start coming off pretty quickly, at least for consolidation. And this is really, I think, a crucial point. I see so many people getting extremely bullish right now, and rightly, because everything's trending higher. And then when we talk about potential risks out there, what they're hearing is that we're talking about things falling apart forever. We're talking about a disconnect here that the intermarket analysis can help us gain better perspective on. And the time frame of those tend to be a few weeks to a couple of 2-3 months or so. It's not a whole lot more than that typically, but those that break of correlation, whether the correlation is positive or inverse, when we get to that, if we use that analysis on top of, let's say, classical, technical, or fundamental analysis, although in the very near term, one wouldn't want to use fundamental, that's a bit of a longer-term analysis, particularly technical analysis, if we can use this intermarket stuff and take it and use it in addition to, say, momentum analysis, people use a relative strength indices and moving averages and all those kinds of things. When we take the structural analysis with it, the intermarket analysis, to me, it really opens up and gives me a lot more clarity and, again, much better risk management. So right now, and we're going to get to the point here, and then we're going to look at the copper signal, which I think is the I hate to use the word scary, but I think the clearest of all. But if we see 10-year yields continue to break higher and make a higher high above 4.2, then the equity market will probably get back some of the gains and consolidate. Remember, I'm not using the words end of the world. I'm not using the words even a recession at this point. It's really just snapback. And again, those snapbacks can be very quick and vicious, and people get stuck. Some people might say, I have a stop loss. You might have a stop loss, but if your trading book is structurally long, very much like your investment account, you're going to be losing money in both accounts. What one technically would want to do, this is not a advice, but educationally speaking, is ideally maybe have the trading book be a bit differently positioned than the investment book, right? So particularly at this point where we've had a really big rally, maybe a bit more short versus long, as opposed to being in sync with the trading book. So again, there's some food for thought. Long story short, we're seeing divergences, and I think they're getting extreme. We can couple this with relative strength indices, and again, all sorts of momentum stuff, which are getting record overbought as well in many individual stocks, and the S&P 500, of course, as well as near there. So we want to be cautious. Let's talk about copper. We talked about interest rates, the correlation of interest rates to equity. We've talked about the correlation of the dollar. Again, those are closely linked in terms of what the signals they're giving. Let's look at copper. And for those of you guys listening, all I'm doing now is showing people a chart of the S&P 500 versus copper. It doesn't matter one bit whether you're looking at this on the screen or you're just hearing me talk about it. Let me walk you through it. Traditionally speaking, the equity market and copper has had a pretty close correlation together. It's not perfect. It's not there every single day, but it's a positive correlation. When we see major divergences between the equity market and copper tends to win out on that signal. In fact, copper just recently made a new multi-month low, in fact, just this past week. And we actually saw the copper market, and again, this is just, it's almost uncanny. Remember a few minutes ago, I talked about how the bond market in yield terms bottomed in late December, roughly around December 28th or 27th. Remember, I also talked about the dollar having bottomed there as well. Guess when copper topped? Almost exactly on the same exact date. This is not coincidence. It's just how things work. Copper then went on to make a lower high when equities just made their latest move higher, which I think is the last leg higher. And we maybe have put in a top for the year, or maybe in the process of putting in a top for equities here. Again, notice what I'm not saying. I'm not saying this is the end of the world. Equities are going to crash 50%. I'm saying it may be a top for the year, which still means that we can just maybe we correct 10, 15%. And then go back up to those highs, meander around there, right? I'm not grizzly bearish here, nor am I even using the recession word anymore at this point. I think we have to wait for more evidence of that, clearly. In the near term of multiple weeks to maybe a couple of months or so, the signal in copper, the lower high in copper, the complete and utter disrespect by the equity market, by what's going on, the signal in copper is very telling. So essentially, copper just made a new multi-month low. Equity is a new multi-month high. When we typically see those divergences, that tends to be a pretty big warning sign. Again, if we, in addition to that, use the traditional market technical analysis, whether that's divergences of moving averages or other momentum stuff, in exuberance, we can even look at investor sentiment. Again, gotten extremely bullish. Again, we're talking about a multi-month sort of period. I'm really hoping this is helpful for you guys, and I'd love some feedback. Please let us know. and email support@thesteadytrader.com if you are finding this kind of information helpful. It's actually really simple. I think most everyone should be able to do this. Pull up a chart of the S&P 500, pull up a chart, peg it against 10-year yields, the dollar index, or copper. Ticker symbols vary based upon your charting platform, so I'm reluctant to give you a ticker symbol because they vary. But again, it's a very simple thing to do, and what you want to look for is major divergences. When we reach those inflection points, okay, and I'll end on this. When we reach those inflection points, like we saw last autumn, for example, when copper actually bottomed in early October, very much like when the dollar topped, and when yields topped, when we see that, it's a matter of time until the equity market does something, right? And this is the kind of stuff that I think is very helpful not only from a trading perspective, but also from a portfolio management perspective, from a longer-term asset allocation perspective. It's very much part of what we do at Blue Marlin Advisors. If you don't have an investment advisor or don't even know what that is, please reach out to us. You can go to bluemarlinadvisor.com, and we'd love to have a chat with you. And again, if you have any feedback, if you find this helpful at all, we would love your feedback. Support@thesteadytrader.com. Just shoot us a quick note, yes or no, in terms of whether you like this or not. Until next time, folks, have a wonderful week. Let's see what this coming week brings. We have inflation data. We have a big option expiration happening as well, and a whole bunch of other information, including the rest of earnings season. So should be an interesting week here. And again, keep these divergences in mind. Until next time, have a great week. We'll talk to you soon.